Good evening, everybody. Tonight we'll start off with a quick session on spreads, which I don't think enough people understand the effectiveness of spreads. They think they're too difficult. They're just as easy as putting on an option trade. So we're going to show a couple benefits, not a couple, three major benefits of spreads. So for those that are here and happen to get happen to be involved with a spread session, what is a spread? Spread's basically a entering and buying and selling an equal number of options of the same class of the same underlying security, but at different strike prices. And the reason we use it is sometimes if we're trying to buy calls on Amazon or Netflix or something like that, it might be way too expensive to buy the calls outright, number one. And number two, we want to reduce our risk or the amount of money we have exposed. So because of candlestick analysis, we have a major advantage of seeing which direction a price is likely to move. Now we want to figure out how to take advantage of it. if your sound is going in and out, you might want to click on the red X up at the top right of your screen, log out, and log right back in again to get a better connection. Okay, so here are the advantages of spreads. And we're going to talk about bull spreads. They work just as well on the put side. First of all, you have less money exposed to the trade. Secondly, the return, if the price moves as expected, the return is going to be much greater. And you don't have to go as far. Oh boy. Somebody might want to type to Ali that they might want to hit the red X and come back in. And the break even is much lower. So the problem with most people buying options is they see a stock going up, they want to buy the calls because that's going to give them better leverage. I would say that probably about 80% of the time that is not the correct strategy. You're better off buying a spread. And that's based upon this right here, the math. So there are times when you might be in a good trade and you will think it's going to continue, but you want to be able to take profits and then reduce exposure on the rest of the move. So spreads work very effectively. When you see a stock that has skyrocketed and you don't know whether it's going to continue, putting a spread on is much more effective because you got less money exposed. If the trade works, it's going to work for you on a bigger percentage basis. And it, again, limits your exposure. So if that price moves inordinately fast, that's when you probably want to put on a spread. So the benefit we have for using candlestick analysis is we've got much better control of analyzing the direction of a market, the timeliness of a move, and the magnitude of a move. So if we see something like this, where it's had a nice strong price move, and we don't know whether it's going to continue, that's probably the time where instead of buying the calls outright, you might put on a spread. Now, one of the first things as far as putting on a spread, remember the mechanics of a spread is that you're buying one call and you're selling the other higher priced call. So it has to be coordinated. So the first thing I do is if I'm going to put on a spread, I want to see what the open interest and what the volume is. If it's something like this, the probabilities of trades going on both sides at the same time is going to be very limited. So they're not going to be able to put that spread on. So a spread is going to work more effectively on stocks that have big volume or big open interests. Yes, and you're probably, you're using the same expiration date. Now, there are strategies out there that are called the diagonals or the butterflies or the iron condors, all these type of things. I don't want to be spending an hour at night trying to figure out what strategy I want to put on. I want to be able to look to see what type of trade or what trade I want to put on, and then I want to know in a matter of a couple of minutes what the best strategy is, which usually limits my trading to buying calls or puts and buying spreads. And then sometimes it's the combination of those two. I don't use delta, Bob. Remember what delta is. It's the normal expectation of a price move during market conditions. Well, we're not using those normal market moves because if we're buying a fry pan bottom breakout, it's because we're expecting a big, huge price move. If we're buying off a best friend signal, it's because we're now expecting a very strong price move. So we're not concerned about what the delta is, which was the accumulation of statistics prior to that move. We're more interested in what's happening in the next price move. So when I do trainings on options, we go very quickly through the definitions of delta, gamma, beta, what's the other one, iota or something like that. But they have no relevancy when you're trading candlestick charts because the next move based upon a breakout or a pattern confirmation is what the new move is going to do. So if I am going to do a spread and I see there's no volume on either side, yeah, so forget the Greeks is right. Because when we're buying a trade in options or in using candlestick analysis, it's because we're identifying which pattern is breaking out and what the result is of that pattern, which is going to be much different than what was happening previous. So my strategies is if I'm buying calls that are expiring 4 weeks out, I'm just going to buy the calls or the puts. If it's something that I can see the price will move in 2 or 3 weeks out to expiration, then I'm more likely to put on a debit spread. And then something we'll get to some other time is if it's a very short duration, like Monday, you see a good debit or a good credit spread that's going to expire on Friday, that trading system is that you've got extremely high probabilities that you're going to make money with that trade, but it's not going to be a big percentage move or a big price move. But it's a consistent way to produce profits. What we're going to concentrate on is the debit spreads. So here's the advantage of a debit spread. Let's say we see a stock is trading at 50 and we expect it to go to 55. And let's say the calls are trading for $2.50. Now if it goes to 55, those calls go to $5, which basically means your 250 goes up to $5 or you've made 100% profit. The final week, I usually use a credit spread. It's not going to make very much money, but it's got an extremely high probability of producing a profit. And we've got the advantage to see that probability improving because we can see, based upon the candlestick chart, which way a price is likely to move during that final week or without any great volatility. All right, so if we bought the calls for $2.50 and it went to our target of $55, the calls go to $5, so you made $2.50 profit on a $2.50 investment. You made 100% profit. And your break even was that this stock had to go from 50 to 52.50 just to break even before you start making money. Now, if we had bought the calls, the 50s for $2.50, and let's say we could sell the 55s for $1, that means we put $2.50 out of pocket. We brought back $1 into our pocket. What determines time frame? I don't understand what that means. Your time frame is based upon expiration. From here to when you're buying or selling all you see is map and no charts. Chris, you might have to log off and log right back on again. Yep, hit that red X up at the very top right-hand corner. Okay, so now what happens is you put out $2.50, you brought in another $1, so your net was $1.50. Or you just need to close the map, I don't know. Yeah, your credit or your debit spread is usually somewhere, I usually try to put it out somewhere between 2 and 3 weeks. Now, to get off course a little bit, the reason for that is if you do a spread way too far out in front of expiration, remember there is premiums, time premiums on both of those spread or both of those options. Let's say that $50 stock all of a sudden shot up to $62 in a matter of 4 days. Well, what's going to happen? Well, your 50s are going to go up, but your 55s may be going up faster because it's closer to being in the money or at the money. So you may have paid $2.50 for that. I'm sorry, you paid $1.50 for that spread. But if you were 4 weeks out, that spread now might go, even though the stock went way up, your spread price of $1.50 may now be $1.20. And it might sit there for 2 or 3 weeks until you get closer to expiration. Obviously, the maximum money you're going to make is $5 on that spread, the difference between the 50 and the 55. So that becomes a maximized on the date of expiration because there's no more premium left in either side. Don't you need to buy back the 55 calls though? Not usually on a spread, because if somebody's going to call the stock and they say, well, we're going to call the stock, and the brokerage firm you're dealing with, so well, this guy has a spread, it doesn't do anything. All it does is they're going to call the stock from you and you're going to call the stock from somebody else, so it's just going to speed up the transaction. But usually when you have a spread on, people aren't going to bother a spread. So here's the difference. Remember, if we put out $2.50 and it went to $5, we made 200 or 100%. If we put out $1.50 and it went to $5, we made $3.50, or our gain was 233%. Do we need to close the spread in order to make profit? If we let it expire, no. No, if you go to expiration, they're going to automatically exercise everything. So if you had a bought the 50s and sold the 55s, and on expiration date the stock was trading at 62 and you didn't happen to be around, they're going to exercise that transaction for you, which means you're going to either buy back the 55s, which would now be trading at 7, and you're going to sell, take profits on your 50s, which were trading at 12. The net difference is still $5. If they didn't close the transaction like that, all they would be doing is exercising. They would be calling, somebody would be calling the stock away from you, and you'd be calling the stock away from somebody else, and the net would still be $5. And in this day and age, you don't have to pay commissions. Okay, let's see if I can find it up here. Yeah, this is just a kind of a rule of thumb. But if you're buying a call that has a lot of time left in it, you're buying the calls outright. If you've got somewhere around 2 to 3 weeks till expiration, you might be better off doing a debit spread. And then the final week, you're going to do a credit spread, but that's a whole different topic. We'll do that some other night. What's the minimum open action that you will trade on a spread or calls? If you look and you see that the open interest is 400 on the 50 side and it's only 75 on the 55 side, that's going to be a very hard trade to get transacted. Now, if you look at something which we will look at like Ford, and I'm going to use this as an example, Jace, of what you said, what should we do with Ford? If they're trading thousands or have thousands of open interest and they're trading thousands of options each day, when you put the spread in, it's going to execute immediately. I mean, as soon as you put it in. So the minimum is you probably want to see somewhere around 1,000 open interest on each side so that you know that they can get that transaction done. Uh, 400 open interest, that's getting a little bit tight. Okay, so where were we? Down here. So we had a 233% gain. But what else does that do for us? Well, if we bought the calls outright, the break even we had to go to 52.50. When you only had $1.50 exposed, that means your break even was now at 51.50. Also, what it helps you do or kind of protects you is, let's say all of a sudden you're in a good trade and then the market just turns on you and the stock trades lower. Well, it's still the difference between the 55. So if you bought the calls of the 50s for $2.50 and all of a sudden the market turned, you may get out of that trade or those calls for $1.10. I'm just picking out a number. Whereas if you bought the spread for $1.50 and the market turned on you, because they're both moving, maybe you're getting back out of that spread for $1.20. Your loss is a much smaller. The width of the spread, yes. So no matter where the stock price goes after, if this stock price, if our target was 55 and it went to 65, well, the disadvantage is your maximum profit was only going to be the difference between the two, $5. Whereas if you bought the calls outright, maybe it would have been a lot bigger. However, you can probably be pretty assured that about 98% of the time, when you're putting on an option trade, to hit that big home run is a lot smaller probability. So you've got, yes, so you're lower risk because you got less money exposed. The break even is lower. And then if the market turns against you, you're probably going to come out with much lower percentage loss. All right, so the relevant decisions are how much time do you have to expiration and what is the strike prices you want to use? What is the place of implied volatility? What is the place? I don't know what that means. Ronnie, if you're buying long-term, yeah, you can use leaps if you want to. And that's the whole purpose for a leap. All right, so the first thing you want to do when you're thinking about putting on a trade, obviously, is what is the market doing in general? Is it heading down, sideways, up? What's the market conditions? And then the next thing is, how far do we think it's going to go up based upon our pattern breakout? Where will it be in 2 weeks, 4 weeks, 6 weeks? So, and what is our target? And we use this example. I don't know if I've left the example up, but if we thought the next target was 1730 and we were buying the calls here, the 1700s at 930, they could go up to, if they hit 930, going to $30, you made a good, decent rate of return. Now what's happening here? Okay. I think here are the numbers. So if we bought the 1700s for 930, it went to $30, you made $20.70 or 222% profit. But there was also, you could look at the spread, and in this case, the spread between the 1700s and the 1710s was $1.80, which meant if it went to 1710, your spread price went to from $1.80 to $10, or an $8.20 profit, a 455% return, and the price only had to go to 1710 versus 1730. Or looking at it the other way, if you had bought the calls outright to make the same amount of money as the spread that only had to go up $10, the price had to go to 1751 to make that same return. Yeah, I had that same problem, Jim. I would close the map, and then the map would pop right back up again. So I don't know what happened. All right, so I also have a parameter that if I'm buying a spread, I don't want to be paying more than $2 for a $5 spread. And the reason for that is you've got some hurdles to climb over, which aren't as much now. Number one, except on a spread basis. You got the commissions, and then you still have to move in the right direction. So basically on a $10 spread, I don't want to be paying more than $4 for that spread. That's just my own parameters. You can buy calls on Amazon, all right. All right, so this is where we set up different strategies. If we've got a fry pan bottom where we expect a big price move, maybe we're buying calls right here and at the same time buying a spread up here with very little money. But if it goes up through that level, that little bit of money now expands to be big percentage returns. So for example, I'm just going to pick out numbers. Let's say we were buying whatever these calls were that at this price, we're paying, let's say, $2.40. And then we moved up here and we bought, say, the 50s and sold the 55s, in this case, way out of the money for 65 cents. Well, now if it does what we expect it to do, coming out of a fry pan bottom, these calls are making money, and then this 65 cents now goes to $5. So you can see that you get much more expansive return based upon knowing what a pattern should do. If we have the timing aspects, you know exactly when to be buying something, and so if it's doing something like this and we think it's going higher, maybe we're buying spreads up here versus calls. The reason for that is because we've got kind of a timing or a measurement mechanism. We know that on a J-hook pattern, wave 1 and wave 3 are going to be approximately the same. So if I see this setup, maybe I'm buying a spread up here for a lot less money exposed, but if it does what we expect the pattern to do, the rate of return is going to be much greater than just buying calls outright. So I think we were doing that on this that if we figured that if this is wave 1, wave 3 could take us up to 85, and these calls might be expensive, but maybe buying an 81, 83 and a half, you're paying 91 cents. But maybe if you bought an 83, 85 for 27 cents, that if this goes to 85, now your 27 cents goes up to $2, where you've made about a 600% profit. So that's where you can dramatically improve your profitability by knowing what should happen. Here's wave 1, here's wave 2, there's your J-hook pattern that could take you up to 75. Now you can put on call and spread combination. So in something like this, what happens if it goes down? It's like anything else. If you put on a spread, you're going to lose money, but probably not nearly the same percentage loss as you would if you just bought the calls outright. Would you ever go extra contracts on Amazon, example, say 5 spread instead of 1, and that would fix the 5 times the 840 profit over 4K using the same amount of money that someone just buying the call would? Or do you prefer one contract spreads? I will try to figure out what you were asking, but if I was going to buy the calls on Tigger, now we just closed out some calls because they gapped up and sold off, figured it was coming back to the T line. Now we were buying them back, so we're up here in a higher risk area. So if I had put in, let's say, $5,000 into that trade, now maybe I'm only putting in $2,000 into a spread. But if it does what we expect it to do, wave 1, wave 2, wave 3, that $2,000 up here at a much higher risk might have a much greater percentage return. So I don't have to put as much money into the trade. If it does work up in a higher risk area, meaning that we think it's going higher, we're kind of protecting or limiting our exposure. Let's see. What happens if it goes down? Obviously, like anything else, but the spread is going to lose less percentage return because it's both prices of the options moving in the same direction. A few people ask about volatility and spreads. I4 is built into both legs of the spread, so in effect you're removing some of the volatility. Yes, you're not worried about volatility. You're more interested in what is the volatility is probably already built into the analysis of that chart. Obviously, 3M is not going to be nearly as volatile as AMC. So that's already built into the price of the options. How to determine how much is a spread? How much? That's what you kind of look at. It's not the value of the spread. It's the math. So let's go to the math. I think I did it on this one. So this was Tigger today. You could be buying the June options, 15 days to expiration, for $2.05. Whoops. Oh, there it is. So if your $2.05 goes to $5, meaning if this stock goes from wherever it was today, I think it closed at 24.86 or 68. And let's say we think wave 3 could take you up toward 30. Well, if you bought the June calls for 205 and it goes to 30, is that right? Yes. That means your options now go to $5, so you made $2.95 profit, or 143%. If you bought the spread, meaning you bought the 25s and sold the 30s, your price would be, and this is exactly what it happens, is on different trading platforms, that price is already figured out for you. So if I click in and I want to buy the 25s and sell the 30s, it automatically shows what price that's going to be. So now I can say, all right, do I want to spend $1.35 for the potential of having to go to $5? Yes, using my rule that if this is a $5 spread, I shouldn't be paying any more than $2 for it. Oops, hold on for a second. I got the raccoons out here having a fight. Make sure they stay out there. So that's a decent entry, or a decent price to get into. I've already factored what I expected my target to be based upon the pattern, that if this is a J-hook pattern coming out through this level, if this is wave 1, and notice why we bought this one in the first place, because of our best friend breakout, told us there's our first target. Now it's breaking through the second target, or the first target, so wave 3 becomes our next target. That's our analysis. Does it work the same in a lower risk area? I don't know what you mean as a lower risk area. If you were, your strategy would be, well, if I was buying calls, but I think it really can go up big, maybe I'm buying half a position of calls and the other half a position of a spread. So that's where you can have a little bit of flexibility to kind of create the maximum profitability of a price move by not just having exposed calls, but also spreads that enhances the returns if that pattern does what you expect it to do. All right, let's see. No, Bob. Yeah, they aren't scary if you know what you're doing. All options is a piece of paper that says I can have the right to buy this stock from you at a certain price in the future. So if you know that, and you know what the hurdles are, which is the price has to move above the price of, so if you're buying a 50 call for $2.50, you already know where your break even is. It has to go up at least to $52.50. But you already made that evaluation by what the chart pattern was telling you it should do. Mike, we do sessions every now and then, Saturday, a full day option training session. And again, once you know it, it becomes easy. It's like that light bulb going off that now you're not just stuck. Yeah, they've only got a limited amount of seed out there, so they fight each other for it. Deborah, it's still a function of, I don't know what per spread. I mean, would I go, instead of paying $2 for a spread, go higher? No, because that becomes part of my discipline. That if I can look at a trade and the option price isn't going to help me make the money I expect for the risk factor, then you pass on it. There's 9,500 trading entities out there. If you look at a trade and it doesn't make sense, move on to something else. You're not in the business to force a trade. You're in the business to make money. So if the trade doesn't make sense, go on to something else. All right, hold on. I'm going to catch up with these questions. Do you put spreads on beginning of a breakout of a fry pan bottom when you see the big signal? Now, usually what I'll do, Rajan, is I will buy calls. And then as the pattern continues to work and I get more confident that we are in a big breakout and it's going to move, then I might go up the ladder a bit and put on a few spreads to enhance the returns as the price moves up. So you match the charts with the different option strategies. No, Jace, I do it the other way. I match the option strategies with what I'm analyzing on the chart. Can you do a delayed spread? Buy the call. I call that a staggered spread, Matt, where if you see something moving big, I might buy a call, the calls in the morning, and then near the end of the day, sell the other calls against it. So maybe on that $50 spread, that was $2.50, and I could sell the 55s for $1 to net $1.50. Well, maybe if I'm real confident, because the market's trading up, the price of the stock did what we expected it, confirming a buy signal. So maybe I'm buying the calls for $2.50 on the 50s in the morning. And later in the day, instead of selling the 55s for $1 like they were in the morning, maybe now I'm selling the 55s after it's moved up substantially for $1.50. So now I've only got $1 in that spread to go to $5. Now that's not free money or free enhancement, because I've already got a profit in the 50s. They may now be trading at $3.25. So I'm giving up that immediate profit to put on the other side of that spread to make more profit down the road. You can do more contracts, Deb. That's up to each person's risk reward. That if but I might still be doing it based on a dollar amount. But if my normal option trade is 5,000, and now we're up at a higher risk area, and I've closed out those options for a good profit, and now it does a turnaround and heads back up, instead of buying back the calls, now I might say, all right, I'm going to do a spread up here, and instead of putting $5,000 into this trade, maybe I'm going to only put in $2,000 to take some more upside. Bob, yes. If you want to stick with the delta and all that, I don't. Because when I saw this, it didn't matter what the delta was from all this. I was expecting this move. So the delta meant nothing to me. This is the move I was looking for. How the entry and exit works on options. Can you buy and sell like you do stocks? Yes. So if I'm looking at this and I want to buy these calls, I'm going to pay approximately $2.05. If I want to do a spread, I then, and it says it's $1.35. Now, in a week and a half, I look at this spread and it's trading at $2.40, and I think the stock is starting to turn around. Yeah, I just put the sell in for $2.40, and that's where they're going to execute the trade. It trades just like buying and selling options. So you will buy to open and sell to open in the same. Yes, you're buying on one transaction. When you put in this order, when you click on send, it's saying buy the 25, sell the 30s, and I want a net difference between the two for $1.35. That's all you have to do. And when you get ready to sell, you put in, I want to sell this 25-30 spread, and right now they can do it for $2.40. You click send, and that's where they're going to sell that spread for you. Michelle, no, I'm picking out the best charts. My first criteria for scanning is finding the best chart pattern setup. Now, some of them will have options, some of them won't. So if you look at the picks and you see there's 3 picks, but 2 of them don't have options, obviously you're not going to trade options on those. You're going to look at the one that might have an option trade. Or if you want to scan for just, ouch, I just bit my tongue. If you want to scan for the best option trades, you set up your scans for stocks that only have options. Should they say it the other way? You're scanning for stocks that, yeah, your universe is the stocks that have options to trade against. Bob, I'm using Thinkorswim. I use Thinkorswim because out of the same account, I can buy stock, options, and futures. I don't have to move money back and forth. Okay, so again, if I bought a spread and it went $5, my profit would have been 270%, whereas if I bought the calls and it went to our target, I'd only make 143%. And I wouldn't have had as much money exposed, and it wouldn't have to move as far to break even. So, Jace, here was your question today. You were in Ford. What should you do with Ford here? You think it's going to go higher, but it's definitely up in the overbought area. It's a much higher risk. So now you look at the options and figure out which strategy might enhance if it goes up further. So you could either buy the, let's see, today it closed, we're at 14 something. Closed at, oh, actually, $15.99. So $16. So I look at the different options. Do I want to buy calls outright? Maybe I want to buy the 15.17. Well, if I'm sticking with my 40% rule, 89 cents is too expensive. So I take a look at the 16.18s. put in 46 cents for it to go to $2, that's a good rate of return. If I want to get a little bit more antsy, I go to the 17.19s for 22 cents. Now if Ford keeps going over the next few weeks and goes up to 19, 20 bucks, that 22 cents now goes to $2. That's a good rate of return. Okay. Do you play weekly or just monthly? I play weeklies if there's enough volume. Now, the monthlies are usually where the big volume is. Now, you could play a weekly. I think this one is a weekly. Whoops, I didn't. This one, now I didn't. Oh, expires. Now, this one was also a monthly. But if you're trading a spread on Apple, obviously the volume on the weeklies are going to be good enough where you can get in and out easily. The profits you are working with are only the full amount at expiration and less before expiration. Does that favor a call over a spread in some circumstances? No. If I bought this for 46 cents and it expires on June 18th, if we get to June 14th and my maximum is $2 on this, and let's say hypothetically on that day the stock's trading at 19.25 with 3 days left to expiration, and this option now is trading at $1.86, my maximum is $2. Now I look at it and say, is it worth holding on to have my $1.86 go to $2, or have I maximized my profit for what I want, close out the trade and move on to something else where I have that same capability? Because I might be looking at a chart that says, oh, it looks like Ford might be backing off. Let's close out the trade now, even though it hasn't gone to the full $2 maximum. All right. Is there a value you use to scan for options for certain values before you trade it? No. No, the options are just a piece of paper that controls the stock that you are analyzing. So the only analysis you want to make is, what is the underlying stock doing? Is this worth buying? Does it have a good upside potential? Now, you have the flexibility to say, well, I'm going to buy the stock. I'm going to buy the stock on margin. I'm going to buy calls. I'm going to buy a call spread. It all depends on what method you want to control that stock based upon what you think the next price move is. Usually on stocks with enough options volume, the volume of the stock should be probably closer to 1 million shares or greater, because the option volume is going to be a function of the volume of the stock. So if you've got a $90 stock that trades 540,000 shares a day, there still might not be enough option volume to, number one, trade the options, let alone try to coordinate buying one side and selling the other side at the same time. Jace, the 40% rule is, if I've got an option spread that's going to maximize at $5, I don't want to spend any more than $2 to get in it. If I've got a $10 spread that's going to maximize out at $10, I'm not going to spend any more than $4 to get into that spread. How do you find the volume in options? On all options trading services, they'll show you what the volume is. I'll try to go to live chart here in a second. For bad trades, when do you roll a trade or morph a spread? I don't morph a spread. It's still based upon what is the price of the underlying stock doing. So if you're buying an option or an option spread based upon analyzing the chart and saying this is what I want to buy, and then you're analyzing the chart and saying, no, it's time to sell, you close the piece of paper that controls that trade, whether you bought the stock outright or you bought calls or a spread. Time will kill you always. Do spreads 3 months or more. Bob, that's up to each person's risk-reward factor. I usually look at options because I know the candlestick charts are telling me what's happening right now. So I will usually buy options that are somewhere around 2, 3, 4 weeks out. What is the criteria for choosing a 1618 on Ford? Why did you choose that one? By estimating where you think the stock price might go. You have a fry pan bottom, they're gapping it up. It's in the spotlight right now as being going to the electric vehicle area, that we could still have some more upside. But we're in a high-risk area. We're in the overbought area, and they've been gapping it up. So do I want to buy calls, or do I want to buy a spread that has much less risk? Let's say I think it could go from 16 to 18 over the next couple weeks. So that's where I'll look to see what the prices are and then see whether this is the best one, or maybe 17, 19. Less money exposed, but it has to go up further. What if the options bid-ask is wide? Well, on a spread, it doesn't matter. They're showing you what they can get it done at, taking into consideration all the bid-ask spreads. If you're buying options outright, if the bid-ask is wide, that means there's probably not a lot of volume. And because they don't have commissions now anymore on options, all that meant is they moved the bid-ask spread wider. So if you have to buy it, you're going to pay the ask price. If you have to sell it, you're going to pay the bid price. So if they're bidding $2 and they're asking $2.40, I'll put my bid in at $2.20 and let it sit there for 5-7 minutes. After that amount of time, if they don't execute it, maybe I'll move it up to, what did I say, $2.20, up to $2.25. If after another 5 minutes they don't execute it, that means there's not enough volume to be playing it, close the trade, and go on to something else. Remember, you're not trying to make money by forcing a trade. You're trying to make money, and if the trade's not going to work, move on to something else. If the trade goes against you, can you close the long leg and let the short expire worthless? You can, but now all of a sudden you're changing the margin requirement. Now you're short a naked option. They may come back to you and say, all right, you need to increase, we're using much more margin to protect that higher risk trade. Bill, yeah, to try to set a preset return doesn't mean a hill of beans. The market doesn't give a hoot where you bought or where you sell. The only thing that needs to be analyzed in the market is what is the stock price telling us, and what do we do based upon that. Not, I hear so many people say, well, when I make 10% on a trade, I close it out. Most people have a hard time making 10% on a trade, number one. And number two, what if that 10% was the beginning of a 140% price move? That means you're going to have to go out and find another trade that's going to make another 10% and keep doing that over and over. If you're buying based upon what a candlestick chart is telling you to do, you sell based upon what the candlestick chart is telling you to do. Yeah, the volume is usually on the option trade, and I'll try to pull up a live chart for that. Has huge, yeah, so there was no problem with option volume on these. There's like thousands and thousands of contracts traded each day. So it's really about the math. Yes, Jace, that is the number one criteria. That's the number two criteria. The number one criteria is analyzing to see what trade you want to be in. The next criteria is what makes most sense math-wise. Can you put in a price that you are willing to pay? Yes. If I wanted to make sure that I got this trade done, and they said we could do it at 46 cents, maybe I say, well, I'm going to move it up to 47 or 48 to make sure it gets done real quick. Okay. So I can go up the ladder and say, all right, I think Ford is going to 20 bucks over the next 3 weeks based upon a J-hook pattern. Maybe I just put out 22 cents. Now, how much money do I put out? Well, if I was buying a normal call on Ford, and if I was going to buy the 16s for 69 cents, and let's say I was going to buy $5,000 worth, maybe if I did the spread, I might only do $2,000 worth. I have less money exposed, and if it does work, the rate of return. Yeah, the 22 cents means if I'm buying 10 contracts, that's $220. If I'm buying one contract, that's $22. All right, so the best place to use spreads is if you see a stock price skyrocketing, you don't know whether it's going to whipsaw, maybe you put on a spread up above. And then if the stock price does move inordinately fast, maybe instead of trying to buy the calls and chase it, you put on a spread. So the advantage we have with spreads is, number one, you have less money exposed. The rate of return is greatly enhanced because instead of having $2.50 in that trade, you only have $1.50 in that trade, which means your break even is lower, and that enhances your returns dramatically. All right, so that's spreads. Oh, and that's just doing the spreads. What do you need in Thinkorswim to do spreads? Let me see if I can pull up the live charts. Hopefully this will fit into the screen. All right, so here is the option ladder. This is Ford. Now, you can see the volume. This is the open interest. Thousands of shares. And tons of options being traded. So there's no problem with, all you need to do on Thinkorswim is you right click on here. It says I want to buy, and then I have another list. If you go up the list here, you hit vertical. And that means it pulls up this screen that says, if I buy the 16s and I sell the 1650s for 19 cents, or I want to go and say I want to see what the 1618 looks like. Well, that's 45 cents. So it all does it automatically. So when you go to your options on Thinkorswim, you just right click on this, push buy, and then you go up, see all the different strategies that are built into this. Well, you just go up to vertical, and that brings up your screen that shows if you buy this one and you sell this one, that's what you're going to pay for it. Matt, that's why some people just trade the options. That's why we have the options room, because that's all they do over there. Okay. Now, let's take a look at what the change of probabilities were today. If I can do this elegantly. Well, for crying out loud. Oops, hit that way off. I think. Okay. So this is the advantage we have visually. Well, for crying out loud. Look what's happening in the market indexes. First of all, we know what the nature of a doji is, indecision. Indecision, indecision, big shooting star indecision. Indecision, but notice which way it's starting to turn, this way. Your stochastics up here in the overbought area. Now, we haven't closed below the T-line, but what are the probabilities starting to tell us? Exactly, Bob. That is what an option is that you're anticipating a price move during a specific time frame. So obviously, if you buy the stock, you've got all the time you want for it to go up. If you're buying an option, you're saying, I'm anticipating this price to move within the next 2 weeks, 3 weeks, whatever your expiration date. Yes. And when we do our option training, that we have all that, not so much implied volatility, because the volatility doesn't mean a hill of beans when it comes to candlestick charts. Or are you anticipating no price move but staying within a time frame? That's another strategy. Unfortunately, that's not a strategy that is conducive to candlestick analysis. Candlestick analysis is pretty much telling us when is the price moves occurring. So anybody can find a stock that's not moving. Let me see if I can find one. There's 3M. There's a stock that's not moving. You can do all sorts of strategies. You can do a strangle, a collar, all sorts of things. We're not interested in that. We're more interested in identifying the price moves that are going to produce the big profits or the high profit trades. What is your smallest time frame in regards to candlestick analysis to find where the option entries? Well, if I'm trading options, it's usually on a daily basis, meaning I want to see what's going to happen based upon a strong price move over the next 2-3 weeks, or at least 2 weeks anyways. If you have 10 call spreads and the market sells off quickly, all your spreads are worthless. But not necessarily. If I bought a spread here for, what was I saying, 22 cents, and it turned around, well, maybe that 22-cent spread now goes to 15 cents. So there's still going to be a market value. Jake, I'm sorry, I didn't see your question. When it gives you a price, I don't skip over people's questions. I'm just trying to read everything fast enough. When it gives you a price, does that mean you're getting it at the ask for the one and buying and selling the one at the bid so you don't have spread, so don't the spreads hurt you? Do you bid lower than what the stated prices are? What you're putting in there, when they come back to you with a spread price, they're telling you based upon what they could get somewhere in between the bid and ask on one side and the bid ask on the other side, what they could net that trade to you for. So that's already built into the price. Now, I have made the mistake, which I tell people not to do, that I was trying to buy something with a spread, and it was like $1.80, so it was below by $2. But then it creeped up to $1.83, and so I moved my spread up to $1.83, and then it moved up to $1.87. I moved it up again, and I said, well, this is crapola. I'll just put it in at market. Well, when you put it in the market, that means they are buying near the ask and selling near the bid. So there was a spread that I thought I could have it go to $5. When I hit the market, they executed me, but the execution price was $4.20, which meant I had to sit hoping that that trade would work out to get to the level that I expected that I could be selling. So so sometimes if they're bidding $1.80 and then they move it up to $1.83 and then up to $1.85, maybe I'll say, all right, let's do it at $1.89, give them some room and see if they can get it done fast. Jake, I hope was that your answer? I forget who I was answering. Jules, that could be, yes. But remember, we're not trading the T-line. Right now, it's in a strong uptrend. So the idea here is, do you buy calls or do you buy stock? Well, where you're way up above the T-line and it's still moving up fast, maybe we mitigate our risk by buying a spread up here where we have less money exposed. But if it does move like we think it could be moving, then that return is still going to be substantial. Okay. Man, I've kept us way past time. So pay no more than $1. No, don't pay any more than $2 for a $5 spread. Okay, so what we're looking for is the breakout type moves. So just to kind of give an advance warning, not this Saturday, but next Saturday, the 12th, we're going to be showing how to track down spreads. It's one of the mini sessions. And so for the hour and a half, it's going to be, I think it's a $27 session. So you get a lot more. But it's going to be the prelude to our full day breakout session for June 26th, which is always scheduled for 4 hours, but they usually last 5 or 6 hours. That's how do you recognize when a breakout is about to occur? Where is the exact place to be buying that breakout? And more importantly, when a breakout does occur, whether you were prepared for it or not, what do you analyze to decide whether you want to get in or whether you wait, or what are the statistics that if it doesn't open correctly the next day, what do you do before you try to get back into a breakout trade? So that will be the full day training. That's going to be later in June. But on June 12th, that's just identifying how candlestick signals can get you ready for what to do on the breakouts. That's a mini session. That only lasts for an hour, and that hour usually goes for 2 hours. Okay, let's go through this real fast of what's going on in this market. Because the market itself, did I do the market itself? The market itself is getting a little bit iffy up here because of the nature. So now you can see that they're having a tough time taking this up. What type of trading trend are we looking at? Probably some sort of wedge where it's oscillating. Now, it was even more evident over here on the NASDAQ that over the last few days, they had a bearish engulfing, then a doji gap down, or kind of your bearish best or bearish doji sandwich. That's telling us they're starting to sell things off. So what becomes your strategy at that point? If I've got long positions on, I want to make sure there's still a lot of strength in them. So you want to stay long on something like Fisker. Tigger was another one that showed a lot of strength today. But you started seeing some things, and I'm going to try to pick them out. OCGN had a good chart breakout yesterday. But when it closed back here, what did it tell us about the strength of that chart? It wasn't there. If you bought yesterday, you closed out today, because what was everything adding up to? The market might be getting weak, number one. Number two, this didn't break out. So what could we be looking at? We could be looking at a fry pan bottom that might not do anything for a while. So look at QS, QuantumScape. Did a doji today after a morning star signal. It's trying to base. But what do we do with this tomorrow? The doji rule. If it opens lower tomorrow, you close it out if you're long and wait for the next buy signal. Why do you wait for the next buy signal? Because for all we know, we might be in for 2 weeks of pullback. We don't want to be sitting long in some of these situations. Same thing here. CGC did a kicker signal, came up, hit the 50 today, and sold off. If you were long this one, the suggestion was you close it out. Even though it hasn't closed below the T-line, what was all the added evidence today? Well, the market was selling off, and this failed up here. Does this look like a very strong chart? Doesn't. Take that money and let it sit, find something better. What's the best BC of current market conditions? What is the best B/C? I need to find out what B/C means. So we know that the gold prices got whacked, which means you don't want to be long gold stocks, maybe even short. Oh, that's because? Oh, what is because of current market conditions? Yes. Why was gold whacked today? I have no idea. Some people would have thought that with inflation ticking up, gold should be going higher. AG, we're working on that. One is the electric vehicles. I'll get to that here in a little bit. I'm going down through some of the ones that we would have stayed in or closed out. You can see I is still staying above the T-line after this big cradle type pattern. Something's going on there. Yeah, so you would think that gold would be going up on higher inflation. But what we think doesn't mean a hill of beans. What the market thinks is what we want to be analyzing. LBRT, another one that is still trading stronger. Look at our little J-hook type fry pan bottom breakout, and it didn't sell off today. But we're in the overbought area. So what do we start analyzing when we're up in an overbought area moving away from the T-line? Where do we put our safety stops? I'd have a safety stop right now at today's open. DMNR, still in an uptrend, but not very strong. If this opens lower tomorrow and I was long, I'd close it out. Even though it hasn't closed below the T-line, the market's getting weaker, and this is still telling us we're in a slow uptrend, but it might be waffling in here. What's it telling us about our probabilities? Our probabilities of it going up are getting a little bit slimmer. Is this the best place to have our money? Probably not. Let's move on to something else. BCRX still moved up nicely in the overbought area. You put your safety stop at today's open. Just logic built into candlestick signals from the Japanese rice traders telling us where is there a change of investor sentiment. Where do we want to start coming out of profitable trades? CEIX held up, but where would be a logical place to say they're selling? Because it came back down through today's open. Okay, that could be too, John. Yes, better than expected. With all the years of experience to see significant inflation like late 70s and early 80s, and you are confident the Fed will act to protect the U.S. dollar? Matt, have no idea. I have no faith in the government or politicians knowing what is the best for our economy. And so I don't try to figure out what their thinking is. What I want to see is what does the market think is going on. If it's something that tells you right now that the market is still heading up, you stay long. If it's telling you that everybody is starting to think the same way and they start selling it off, I want to be short. There's only one correct assessment of the markets, and that's the market themselves. We don't have to try to figure out what is happening that will make the market go up or down. All we have to do is see what's going on is making the market go up or down. Krish, I didn't make any recommendations. I just said you're probably starting to see the market starting to turn over, and the NASDAQ was even more forceful with the bearish engulfing signal followed by a bearish doji sandwich. That's a pretty good indication that the sellers are starting to take control. Do you always use the end of the day close for a stop, or do you at times use a low of the day? If I think the market's going down and I see something come back down through the low of the previous day, that's telling me the sellers are in control. I'll close it out then. Sava maintained its uptrend with kind of a good strong day, opened lower and immediately started trading higher. So yes, use put your stop at today's open on Sava. Rita, been stronger than bear's breath ever since the Morningstar gap up. But same scenario. Where would be a spot that tell us that the sellers are taking control? Shooting star, doji, long-legged doji, bullish confirmation. I'd have a safety stop right here. If it comes back down through there, all this is now starting to take place or take effect. APPH, ever since our bullish Harami best friend gap up, what was our analysis? You stayed long as you didn't see a sell signal or close below the T-line. However, now you're up here in the overbought area. If this opened lower tomorrow, which would be kind of a function of the market opening lower, I'd start taking off at least half the position. Then if it came back down through today's low, that tells me exactly what's happening. They're selling it off. You close out the other half of position. Hecla, this is the reason why you want to see or be a little bit more diligent. You can see the uptrend was indecisive. Then they took it up, still indecisive. But when they gapped it down today, what did that tell you about the trajectory? It's now in doubt. Would it closed out the trade? Because the very simple rhetorical question to yourself would be, is this the best place to have my money? OCGN closed down here. That wasn't telling me we had a strong chart, and the market looks like it's starting to go soft. Same scenario on BTX. It came up, and then it closed way down here. So the question is this the best place to have your money with the market starting to get soft? I close this one out with a very simple strategy. If the market opens up and we wake up tomorrow and the pre-market futures are showing the Dow is going to open up 120 points and this is opening positive, I can buy it back. On the other hand, if the market opens weak and this is trading weak, it's not going up. Let's see, let me read this. Can you please explain the psychology on this? For tomorrow, I opened the trade yesterday as it went through the 50. Today, it gapped down into a doji right on the 50. The T line is below the 50, but if someone is watching the 50, are they selling it? If it drops below the 50 tomorrow and the start of today, would you still be holding until it closes below the T line? Is that where we place our safety stops? No. If this opens lower, it closed right here. If this opens lower, what's it telling us about the uptrend? It's not there. Doesn't mean it's out of the picture. It means you close out the trade and you wait for the next buy signal. Matt, because we're technical traders, and if you keep in mind what the definition of a candlestick signal is, the candlestick signal is the graphic depiction of everybody buying and selling during a specific time frame, which means they've made all their decisions based upon most investors in the world that buy based upon fundamental reasons. So all we're doing is seeing the graphics of everybody's decisions based upon their analysis of the fundamentals. So the only time I use fundamentals anymore is if we see, I'll have to go back here, if we see a gap up and it's doing a kicker signal, then you go and see what the news was that created that signal. That's what we call the RARE process. Reverse analysis, research engineering. No, the other way. Research analysis, reverse engineering. We want to see why the signal is being formed and what is causing it. So the long answer to that is no, we're not concerned about the fundamentals. We're just analyzing what everybody else's decisions are based upon their analysis of the fundamentals. So on something like this that had a kicker signal today, go back and find out what the news was that created that signal. Yes, art, but just to give you an example, this is why you listen to the charts, not what somebody's saying. I forget where it was. I think it was somewhere in here that Kramer came out and said this was a very good stock. But look what the rest of the market thought. It hadn't started anything yet. Do you take into account the worst sale. No, the worst sale doesn't mean anything to trading. The worst sale is a tax term, meaning if you own a stock and you're down and you're going into December and it's December 20th and you sell that stock to take a loss, the worst sale means you can't buy that stock back for 30 days. Otherwise, if you buy it back within that 30-day period, you are entitled to the loss of the previous sale. So it only refers to the tax ramifications. Okay, let's get through some of this. Nimrod. Nimrod up here in the overbought area did a big bearish harami, still trading above the T line, but what are the conditions of the markets? The conditions of the markets are that it's heading down. There may not be a lot of upside potential left anymore in this one. Take that money and go someplace else. The biggies, Tesla, getting whacked because they have a recall. That might be what is helping out Ford and GM. Apple, you can see ever since it failed up here, you're in a downtrend. Amazon, you're in a downtrend. Brian, no, why do you want to hedge the market? If you're sitting in here watching stocks or you're close enough, you don't want to be hedging. You have the capabilities of analyzing the chart to see whether you should be in it or out of it at any given time. No, I wouldn't call this a trend kicker, but again, it's still that same aspect. You can see the dumpling top. And NVIDIA was acting strong, but stayed strong. So you can see where NVIDIA has been staying above the T line. But things like Netflix, you can see which way this is going. Ever since your shooting star failure at the 34, that's probably got more downside. Also, Ford is helping out Ford. Chris, you got me there. Ford is helping out Ford. They introduced their new small Maverick pickup. All right. Okay. These are the toughies to trade. AMC. Got a long-legged harami. Rajan, you said you wanted to think about going short on some of these. Now you've got more clarity as when to go short. Long-legged harami, or spinning top harami. If it opens lower, that pretty much tells you they're pulling the plug. Same thing over here on BB, BlackBerry. Starting to see selling. You could start shorting this one on weakness. Apparently you don't let the tax consequences tail wag the trading plan. That's correct. We're not in here to save taxes. We're in here to make money. Taxes are just part of the playing field. Okay, so some of the good areas. Clean energy. There's your nice fry pan bottom breakout. With a best friend. Why is that important? Because the best friend is what creates your strong uptrends. That's true too. Cons, there's your fry pan bottom breakout. with your best friends. Now, this type of analysis, when you know what a best friend is, what a pattern breakout is, you're just improving your probabilities that you're going to be in the right trade at the right time. And you're also giving up this fear factor that, man, I don't want to be chasing this one. You're not chasing if you know what it's supposed to do based upon that pattern breakout using a strong signal to break out. Moxie, you can see what's happening here, right back to the T-line. Big price move, J-hook pattern. Doji today. What's the Doji rule? It's probably going to move in the direction of how they open after a Doji. If this opens positive tomorrow, you got a good probability of taking it back up again. Now, why do I say good probability? Number one, because we know what the signals should be telling us, or the confirmation of those signals. And number two, why is this more interesting to trade? Because it's just moved from whatever this was, 750 to 25, pulled back. If this moves again, your percentage returns based upon analyzing what the chart is telling you has much better prospects than a stock that might only move up 6%. In a daily time frame, you're a little above the T-line, but in a 10-minute chart, 531 chart, you're below the T-line. What do you, if you're trading the daily chart, the intraday charts don't mean a hill of beans until you've moved way far away from the T-line. The daily chart or the intraday charts mean nothing if you're still trading along the T-line. So remember, you're using the intraday charts to tell you what to do when you get out of whack on your daily charts. Just so you know, I appreciate your one-on-one seminar. It has made a significant difference. Good, Raisin. I hope the kids are taking advantage of it too. Can you review the different color lines? The 200 simple day moving average. The 50-day simple moving average. These moving averages are on our charts, not for us, but it's telling us what everybody else that has these moving averages on their charts, what they're doing at those moving averages. Then you've got the 34 that works relatively effectively. And when I say relatively, the nice thing about candlestick analysis is we know the signals work. Anything that we can, oh, she's up 40%. All right, tell her to send me something. Anyways, anytime you put something on your chart, it should enhance your analysis or enhance the analysis of what the signals are doing. Then you've got the black line. This is the most important. You could take everything else off this chart and use the T-line. The T-line acts like a natural support and resistance level of human nature. So here's the most important statement about candlestick chart analysis. If the candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame or investor sentiment, which works extremely accurately or we wouldn't be looking at them today, and the T-line acts like a natural support and resistance level of human nature, when you add those two together, you have an extremely powerful combination for analyzing a trend. So we have Ford, whether you want to call it a reaction to the electric vehicles. You've got GM, same scenario. You've got Solo that came out of this fry pan bottom. I would suspect the next target is the 200-day moving average. You've got Fisker, which we're staying in. Staying above. Now you're starting to move away a little bit, but so you want to watch to see what happens here. The 34 is the EMA. There you go. I'd sure hate to have that voice in my head, Chris. Score, kind of a fry pan bottom with a kicker signal breakout, implying there's more upside. ASXC. What is the friend sign? What is the friend sign? What is the friend sign? Newton, you got me there. What is the best friend signal? Is that what you're asking? Best friend signal is a doji, which represents indecision, followed by a gap up. We call it your best friend because it has two elements to it. One, the direction is going to be extremely high that it's going in a positive direction, or the probabilities are going to be extremely high it's going into a positive direction. Number one. Number two, the magnitude of that return is going to be extremely strong. So this is why you want to learn first the 12 major signals. That's your bread and butter. That's the information built into human nature telling us when there's a change. Then you want to know the patterns, because human nature works the same way time after time. That's why we see patterns in the markets, because investor sentiment works the same way. And then we've got things that improve the probabilities of the combination of the signals and patterns, like your doji gap up, best friend, or your fry pan bottom breakout. What kind of moving average is the T-line? I can see that it's quick. No, it's the 8 exponential moving average. This little green line is your 3T line, the 3 exponential moving average. And no, we're not trading crosses of the moving averages. We're trading the signals. Everything else is just a confirming indicator. Now, you do get a little bit of benefit of knowing that if you see a candlestick buy signal and the 3T line comes up through the T line, that's just a little bit more added conviction that the investor sentiment has changed. PSAC looks like a J-hook pattern setting up. Notice your doji type, that's not even a doji sandwich, but you have a J-hook pattern breakout on this one. The steel stocks, Schnitzer steel looks like it's trying to do a J-hook going into wave 3, and U.S. steel. That's why my mouth is so dry. I haven't taken a drink for a while here. U.S. steel, let's make this bigger, has to open positive and trade positive to stay in it. If it opens lower, what's it tell you about your trend? It's now sideways. You want to be someplace else. Workhorse had a big gap up today. Another one of the electric vehicle sectors. So very simple. The doji rule. If this opens positive tomorrow, you can be buying it. And Schlumberger. Nice J-hook pattern. I think Halliburton was somewhat the same. Yeah, nice J-hook pattern. Matador. Still in a nice slow uptrend. Workhorse, is that a no, that's a breakout. You have a kind of a fry pan bottom breakout. So if it opens positive tomorrow, the doji rule says it's going to trade positive. So if I was buying this tomorrow on positive trading, where would I set my stop? Right here at the low or the open of the doji, because if probabilities say we should be going in this direction, if they open it and bring it down through here, they're not buying it. Okay, on the other side of the coin, with the market kind of getting a little bit toppy, These are the type of charts you want to be looking for. BEKE, have no idea what they do, but look at the bearish kicker signal failure right here at the 50. That was the same thing today. We started buying puts on Splunk near the end of the day. Because look what happened here at the 34. There's your bearish kicker signal. Not only was it a bearish kicker signal, but when they tried to bring it up, they failed right at the T-line. Now, for those of you that are new, the reason that's significant is nobody has the T-line on their charts. So when it hits that level, it's hitting a level that nobody has on their chart. We can see it because we put the T-line on there. But because it acts like a natural resistance level, we know there's probably more downside, maybe to the point of this direction. Oh, Deborah, I'll just bring this up if that's a good one. There's your bearish left-right combo right at the 34. Bidoo is probably a good short. We also shorted, this is the advantage of being in the chat room. Who mentioned it today, Deborah? Was it? Forget who it was. Nancy or Diana mentioned Coles. Bah. You could see the dumpling top. Where do you think the next likely target for this one could be? Probably right down here, and maybe all the way back down to the 200-day moving average. So we bought puts on this one because there's your dumpling top, which is the opposite of a fry pan bottom. Netflix also has that rounding top failure. At least we can factor that this is probably the next target. And then if it breaks through there, it's probably coming down into this range. So this is why I was emphasizing the fact, here's Chegg. Another, if this opens lower, what do we got going on? Wave 1, wave 2, bearish wave 3. So, oh, I forgot to finish my statement. The fact that we're identifying that the markets might be selling off, you add that to the fact that there's a lot of charts that you would be going short no matter what. And that would be enhanced by the fact that if, where would you put your stop on a cold short? I will ask you that. Where would be the place that would tell you that they aren't selling this one off? What rule, Jake, would you be applying here? A close above the T-line, exactly. That would tell you your probabilities have gone against you. My stochastics are 12, 3, 3, slow stochastics. Now remember, the signals work well at the extremes, overbought or oversold. A pattern breakdown is usually going to occur when it's already in an overbought or oversold condition. Why not halfway between today's open and close? Because it would still be below the T-line. Is the best friend gap up measured from the doji upper body or the doji's high? You like to see it above the high. Trying to think of one. You want to see it, you want to see the gap up. Now, a doji followed by a bullish open and trading positive is still a reversal, but the best friend shows a lot more strength. That's a doji gap up above any of the previous day's trading. And the effect of lower Gold prices, you can see the kicker type signal, failure at the 200. Where do you think your next target's going to be? I would probably suspect back down here to the 50. ATER, observe the obvious. And this is more obvious when you say, all right, which way is this trend? This trend is heading in this direction. What happens in a downtrend? When it comes up to a resistance level, and you're already in a downtrend, look what's happening at that resistance level, in this case, the 200. Here's your bearish engulfing signal. What's the implication here? That this one is still in a downtrend. What chart number you use? What chart number you use? Curtis, I don't understand what that means. And what do you think this one is doing? Still heading down, probably heading back to the lower end of the channel. Curtis, are you retyping your question? Mavis is one that a lot of people are following. There's the fry pan bottom. If this opens lower tomorrow, it's probably coming back to test the T-line. If it opens positive, there's your double doji confirming your fry pan bottom. You can be buying it immediately. The cruise stocks, where was this running into trouble? You could pretty much draw a line right through the tops here. So what would that tell you? If this opens lower tomorrow, you close out the position. And that's also going to be a function of the market in general. Do you use daily? Oh, they're all the same. This chart has all these same indicators on a daily chart as if you flip to the 5-minute chart. Same indicators. Or the 10-minute chart. It's still all the same indicators work well no matter what time frame. Okay, Reagan, I know those calls, so see you later. Okay, so are there any, what platform are you using? Meaning what chart? These are the charts we use here. This is called CQG. These are expensive. This is the grandfather of the charting services. This is about $1,400 a month. It works fast, it's clear, but you've got just as good charts on your a lot of your charting services, or a lot of your trading services. The trading platforms, or the trading platforms, I use Thinkorswim at Ameritrade because I can trade stocks, commodities, options all out of one account. They're all as good or bad as each other. Jake, yes, I would probably be shorting Apple. Now this is the 10-minute chart. This is the daily chart. You could be shorting it. Do you go over charts in your service during the day? Yes. We put out 2 or 3 stock picks every day. They're not supposed to be stock picks that you just follow blindly. We put it on in a 2 or 3 minute video to say what the market's doing based upon the signals and patterns. And here are the stocks we would be buying and the reason. So we're not putting out picks just so you have picks. We're putting out picks so you can see what the rationale was or the analysis was using the candlestick charts to make those decisions. So when the market opens up, we already have people, the chat room is always open. People are texting back and forth. I'll put out texts in the morning. And then late in the morning, usually around, well, at around 11:20 over in the options room, we'll come in and we'll start discussing some of the option trades that should have been put on or can be put on. And then around noon time, I'll try to come into the main room, and I'll be in, I'm supposed to be in for an hour, but it's usually lasts like an hour and 45 minutes, which means everybody's starving by the time I get done so they can go have lunch. And then I'll come back in about 15 minutes before the market closes to see what should be closed out and what's going on. Would I have a target for Apple? No. It could be a wave 1, wave 2, going into wave 3. Mo, we'll have to do one of those. We did Ford. So when I tell Jim to do the double line, because we're so far behind schedule tonight, everybody kind of keep their requests to one. What would the target for Apple be? Yeah, if it breaks here, you got wave 1, wave 2, wave 3 that could take you all the way down. And again, that's going to be a function of the market in general. Okay. Any other general questions on candlesticks? No, a blue ice failure is when it comes back up and fails, it goes to the next and it's already here. I wouldn't call this a blue ice failure. I don't know the difference between fast and slow or full, and I don't care. All I really want to know is, am I seeing a candlestick buy signal in the oversold area? Obviously, if you see a candlestick buy signal in the overbought area, it doesn't mean anything. Or if you see a candlestick sell signal in the oversold area, it doesn't mean anything. Okay, any other general questions? Oh, yeah, so anyways, first of all, I keep reiterating, if you learn the 12 major signals, you're going to be way ahead of everybody else. Even if you're using somebody else's technique, if you overlay candlesticks on your charts to analyze what they're recommending, you'll get a much better feel or a much better analysis of what that price is actually doing. The reason we're looking at candlestick signals today is because over the last 400 years, the Japanese rice traders have analyzed what happens in investor sentiment that creates reversals. We're looking at the reversal signals. We're looking at the patterns. That's what moves prices. So back to somebody's question, do I pay attention to fundamentals? Absolutely not. Everybody else is paying attention to fundamentals. We're just analyzing what their decisions are based upon their analysis. Yeah, and Becky put in the spotlight again. That's 27 buckaroos. That's 1.5 Starbucks coffees. You get a lot more information than your money's worth. A lot more. Okay, I guess with that, Jim, go ahead and do the double line. Keep your requests to one so we can get through before the cows come home. And Jim, in 2.6 seconds, do the next double line. OEG went dead. Here's a perfect example, and this is what we're going to be teaching in 2 weeks from now. 3 weeks, the 26th. If you have a big move like this, if it opens lower the next day and trades lower, close it out immediately. Because the probabilities are it's not going to go up until it gets back up through this level. So this one you should be out of. PDAC. That one is not coming up, Bob, so that's a lap. ELOS, another one that has a fry pan bottom. You're right here kind of at a breakout level, but it's selling off with a hanging man. If this opens lower, they're coming back to test the 50. Space, getting a little bit dicey. See the long-legged doji. I don't know where this line came from. Now you're starting to see some selling. You're up here in the overbought area. If this opens lower tomorrow, again, probably a function of the market, close out the position. J-hook still in progress. Should you look for you? The J-hook needed to break out to this level, and as you can see, this was a bearish day. If they open lower, they didn't break out. Move on to something else. Kind of a, I don't know what you would call that, but it's broken through this downtrend, so you stay long right now. That's not what we wanted. TD, that one had a bearish engulfing, tried to come up. Right now, if this opens lower, you close it out. Buy on positive trading for a J-hook? No. On this one, are we looking at the same thing? Toronto Dominion Bank? No, you got a bearish engulfing, and now there's trading back below the T-line. To buy this one, I probably wouldn't pay attention to this until it breaks up through this level. Otherwise, you could be in a sideways. And Solo, still a good chart. Nail, that one you get ready to go short, especially if they open it lower, giving you a bearish doji sandwich that if it's that magnitude, they're breaking this level, there's your bearish J-hook pattern, likely to take you down to the 200-day moving average. BGCP. Notice where you are, right about here. If you're long, you put your safety stop at today's low. Because if it comes back down through there, that means they're pulling back. So again, this is why the warning went out today that the investor sentiment was changing a little bit. And if you know that, anything that looks a little bit iffy, take your profits. There'll be better trade setups instead of staying in something that you're hoping is going to go up further. Same scenario here. I don't know what that line is. Is there something over here? Yes. Look where you are. Fry pan bottom, and you're right here at the breakout area. But look what type of signal it's producing over here. Oops, said that wrong. I thought it was a bearish candle. You stay long, you definitely need to see this open positive, but you're in the overbought area. Your safety stop is at today's open. Peloton, I'd be ready to go short on lower trading. SOS, pretty much nothing here. To stay in this one, it needs to see good strength immediately tomorrow. If it opens flat or sideways, I'd move someplace else, or at least wait for the market to give us some better trades. Tom. mRNA, you stay long on this one. The spiders, I didn't know that. That's good to know. Getting a little bit toppy. Oh, the gas and oil spider. Another one that I'd have a safety stop just below today's low. You're seeing dojis up here in the overbought area. Have your safety stop in place. SESN. Another one that I'd get ready to close out if it trades lower tomorrow. If you're long, stay long, but I'd probably put a safety stop at today's low. Semiconductors starting to sell off, at least probably coming back down to test the 50. Then you have to watch to see what it does from there. Disney, you can get ready to go short. Failure kind of here at the dark cloud, little dark cloud right here at the 34. If this opens lower tomorrow, you got a very doji sandwich telling you this downtrend is still in progress. And DSG, that's your best friend gap up. If I was buying this one tomorrow, I'd probably buy it once it gets up through the 50-day moving average, just to get that out of the way. Las Vegas Sands, you could short this one with the expectation you're heading for the 50. Valero, another one that I would probably have closed out today, but if you stayed long, get ready to close this out if it opens lower tomorrow. Jemiah, stay long, use today's low as your stop, which is also the T-line. Zenga, and I'd be ready to go short. Look at your bearish left-right combo, kind of resisted. I'd be ready to short this one. Oh, that went off. Oh, where did that come from? Mercy. Stay long. Kind of your fry pan bottom breakout. Now you're in a 45-degree. TNXP. That's a little bit dicey. It doesn't look like it has a lot of volume. If this opens lower, I'd probably close it out. That's just, yeah, I better make this smaller just to see what we're looking at here. Yeah, you can see that you've got a resistance level right there. If you're long, it has to trade positive and get through that level. That was TNPX. Storage, you should be out of this one. I don't know whether I'd be going short just yet. You could short it on weakness. And plug. You can see it's having a hard time getting through the 200. If this opens lower tomorrow, I'd close it out and wait for the next buy signal. BTX, we close this one out today. Because of the weakness, we can always buy it back, but if this opens lower tomorrow, it means it's not a great chart anymore. How do we know that sentiment is changing? Jake, you must have missed it, because I think we've looked at it about 3 times now. Look at your indecisive trading up here. Doji's in the overbought area, and things are trading lower. And now the uptrend in the NASDAQ has seen a bearish engulfing signal and a doji gap down through the T-line. Stochastics rolling over. This is pretty good evidence that the sellers are starting to take control. ExxonMobil, you can stay long. QuantumScape needs to open positive and trade positive, giving you a doji sandwich. If it opens lower tomorrow, boy, it has to stay above the T line, but it would be taking the wind out of the sails on this one. Las Vegas Sands, no, a blue ice failure is when they fall. This is more of a blue ice failure, where they came down, fell through the ice, came back up, couldn't get through, they drowned, they went to the bottom of the pond. This is just now a failure at the 50, probably heading down. No, it's not too late to buy this one, but it's not the best place to be buying. Where was the best place to be buying? Here's your best, kind of your doji gap up, doji sandwich. You can stay long. You can buy it, but you just want to make sure your safety stop is in place immediately. Boeing. That one you would have closed out today. With the doji in the overbought area after gapping up a little bit, where do you think the next target is? They're coming back to test the T line. Jace, it's just you. If you get into a good downtrend, you'll be surprised how well puts work for you. We bought puts on this one when it gapped down from a hanging man and closed it out right here just because we were that far away from the T line and we went to the 10-minute chart. So puts work just as well. That one should work. And a bearish kicker signal usually implies there's more downside. KBH, look at your failure. This would be kind of in that category of a blue ice failure. If this opens lower, what do you have after the sell signals? A bearish doji sandwich. Where do you think your next likely target will be? Kevin, I didn't read far enough. Yes, you want to be shorting this one. You wrote that big dissertation, one word, and I didn't read that far. CCIV, long-legged doji in the overbought area. If this opens lower tomorrow, they failed to break out. LNTH, stay long, have your safety stop at today's low. Magna, you can stay long, have your safety stop below the T line. Chris, sometimes, yes. So anything that looks attractive as far as a short, remember there's only one decision to make when you're shorting something, and that's sell. When you're buying something, you're thinking, oh, should I be getting in this? How much should I get in this? How much money should I put in it? Where should I buy? When people sell, they say, man, get me out. Bang, they hit the sell button. What's your favorite short? Well, they bought puts today on Kohl's. It'll probably be recommended as a short tonight. And then right behind it was Splunk with a bearish kicker signal, anticipating they could come down into this range. NFG, That's a good little best friend. Fry pan bottom type pattern with the doji sandwich breakout. You could stay long on this one, or you could be buying this one. What is that symbol? Is it ILIM? I don't see what it is. All right, so investor sentiment, you have to kind of assume that the prospects, if they open, if we wake up tomorrow with the pre-market futures showing more downside, there's still going to be some sell-off here. Okay. June puts now with 3 weeks left to expiration. Yes. But what could happen in 3 weeks? We could be down here. So we look to see what could happen on the relatively short-term basis. When you buy puts calls, do you look at specific delta? No. Don't give a hoot about delta. I'm more interested in what is the strength of the next move. So if this is breaking down, could have a good strong price move. If something is breaking out to the upside, the previous delta has absolutely nothing to what that next price move is going to do. Futures are up. I've got the Dow futures down 34. Anybody got anything different? And secondly, it doesn't mean a hill of beans where the futures are right now. It looks like the Qs are down after hours. Yeah, so again, this is why as soon as and I've done this enough times to myself, that if I start seeing things that are iffy, and I've got trades that are becoming a little bit iffy, especially if you're trading options, I close them out because there's going to be another good trade someplace else. Why stay in something where you're hoping things work out after seeing things not looking good? Ernie, that's up to each individual. Obviously, the more in the money, the more conservative. The more out of the money, the more risk-taking. If I'm seeing something like this, that if this was confirming and I thought it was going to be a strong move, I might be buying calls and then maybe out of the money spreads. Okay, I've kept you way past bedtime now. So with that, we'll see everybody bright and early tomorrow morning in the chat rooms. We'll see you then.